a newly announced banking guideline centered around the figure of $250 has recently been officially confirmed by federal authorities. If you currently receive Social Security, a pension payment, or any form of government benefit, this information may be directly relevant to your financial situation starting right now. Tim here with Seniors Pathway, and today we are going to walk through exactly what this guideline means, who it may affect, and most importantly, what practical steps you can take to help keep your money both safe and accessible every single month. Please stay with me through the entire video because the details covered in the second half are the ones that most people tend to miss, and understanding them fully can help you avoid potential complications down the road. Let us start from the beginning. A new federal banking compliance update has been officially finalized, and it revolves around a $250 monitoring threshold that financial institutions throughout the country may apply under certain defined circumstances. Before any worry sets in, it is essential to understand this clearly and completely. This is not a reduction in your benefit payments. It is not a newly introduced fee. It is not a restriction on how you choose to spend or access your own funds. Rather, it represents an added layer of financial oversight specifically designed to help protect the accounts of everyday Americans, with particular attention given to seniors from the growing wave of fraud that targets retirement income directly. Here is the reason this subject is generating discussion right now. Fraud schemes have grown considerably more sophisticated in the methods they use to go after older adults. In many situations, criminals deliberately try to take advantage of the exact timing when benefit deposits, such as Social Security checks or pension payments, land in bank accounts. They may attempt to move quickly and take action immediately after those deposits are made. In several documented situations, by the time the affected individuals noticed something was wrong, the funds had already been transferred elsewhere. Because of these recurring patterns, federal regulators have been actively working to strengthen the financial monitoring systems that banks use every day. The $250 monitoring threshold is one of the instruments created to help flag unusual activity before serious financial harm takes place. So what does this guideline actually involve in practical terms? Banks may apply enhanced monitoring procedures to certain transactions that meet or exceed $250 under specific and defined conditions. Think of it not as a roadblock, but more like a security camera that becomes more focused and attentive when activity begins to look out of the ordinary. Standard everyday transactions such as grocery store purchases, utility bill payments, rent contributions, or insurance premiums typically continue moving through exactly as they normally would. Monitoring systems are generally built to detect activity that looks noticeably different from a customer's established banking pattern rather than flagging routine everyday spending. Here is a straightforward example to help illustrate this. If your account has maintained a consistent pattern of activity over many years, with regular deposits arriving and predictable bills being paid around the same times each month, that pattern becomes something the bank system recognizes as completely normal behavior. Now imagine that someone gained unauthorized access to that same account shortly after a Social Security deposit arrived and then attempted to push through several rapid transfers to unfamiliar recipients in amounts at or above $250. Activity that looks strikingly different from the account's established pattern could prompt an additional layer of review. The purpose of that monitoring is to pause suspicious movement before funds travel any further away from the account holder. A question that comes up frequently is whether this kind of monitoring could interrupt everyday banking. For the majority of seniors who maintain steady and predictable spending patterns, the honest answer is generally no. Routine bill payments, standard purchases, and typical cash withdrawals are usually left completely unaffected. Monitoring systems are typically designed to zero on irregular or unexpected activity rather than transactions that fit squarely within normal behavior. Individuals whose account activity remains consistent from month to month are generally the least likely to experience any kind of review at all. Now, let us talk specifically about Social Security, since that benefit tends to be a central part of this conversation. Retirement benefits, disability payments, SSI and SSDI all continue to follow the exact same federal deposit schedules they have always operated on. If you normally receive your payment on the second Wednesday of the month, that timing stays exactly the same. If your deposit arrives on the first of the month, Nothing about that changes either. This guideline does not alter benefit amounts, modify eligibility requirements, or shift deposit schedules in any way. Instead, its focus is entirely on monitoring unusual activity that may occur after funds have already arrived safely in a bank account. Similar protective measures can apply to pension income as well, whether that income originates from a private employer retirement plan, a public sector pension system, or a program such as railroad retirement benefits. Cost of living adjustments that are determined by established federal formulas also continue according to existing policies. Any increases tied to inflation or annual policy reviews would still take place exactly as those programs dictate. The $250 monitoring concept operates quietly behind the scenes as a protective tool rather than functioning as a barrier to normal, everyday banking activity. It is also worth taking a moment to understand why older adults have increasingly become targets of financial fraud in recent years. Reports from consumer protection organizations indicate that financial scams directed at adults over the age of 60 have risen steadily as more banking services have moved into digital and online environments. Fraud attempts may come in the form of phone calls, text messages, emails, or even physical mail that falsely claims to represent a government agency or a financial institution. Some individuals attempting fraud try to manufacture a sense of urgency or pressure, pushing people to move money rapidly before there is any opportunity to stop and verify the request. In many documented cases, the entire tactic depends on rushing the intended victim into acting without thinking. Monitoring thresholds can disrupt that sense of urgency by triggering a pause whenever unusual transfers are attempted in quick succession. Even a brief delay can create enough time for a customer or a bank representative to step back and confirm whether a given transaction is genuinely legitimate. For someone managing a fixed monthly income, even a few $100s represents a meaningful and important portion of their budget. Early detection of suspicious activity can therefore make a very real and significant difference in someone's financial well-being. Federal officials have characterized this type of monitoring as one component of a broader effort to bring consumer financial protections into alignment with an increasingly digital banking environment. Modern banks process millions of electronic transactions every single day. Automated monitoring systems give those institutions the ability to scan for unusual patterns across enormous numbers of accounts far more efficiently and rapidly than any manual review process could accomplish alone. This brings up an important question worth addressing directly. What actually happens if a legitimate transaction gets flagged for review? In many situations, the bank will simply reach out to the account holder to verify the transaction in question. That outreach might come in the form of a phone call, a text message notification, or a secure message delivered through an online banking portal. The customer may be asked to confirm their identity and indicate whether the transaction was something they personally authorized. Once that confirmation is provided, the review process can typically be completed without significant delay. It is worth remembering that such reviews are not accusations of wrongdoing. They are precautionary steps taken to confirm that account activity reflects the genuine intentions of the account holder. Responding with calm and simply verifying the transaction in question usually brings the situation to a quick and straightforward resolution. If you ever receive a message that appears to come from your bank and something about it makes you feel uncertain, the safest approach is to contact your bank directly using the official phone number printed on your debit card or on your formal bank documents. Never provide sensitive personal details in response to an unsolicited message, regardless of how official it may appear. Now, let us consider seniors who prefer visiting a physical bank branch rather than managing their finances online. For individuals who conduct their banking in person at a local branch, the day-to-day experience generally remains exactly the same. You walk in, speak with a teller, make deposits, withdraw cash, and handle any questions you have just as you always have. Monitoring systems operate entirely within the bank's internal technology infrastructure, meaning customers are not typically required to complete extra paperwork or sign up for anything special simply because monitoring tools are in place. For those who do use online banking platforms or mobile banking applications, these monitoring systems function alongside the security tools that already exist within those platforms. Features such as two-step verification, Deposit notifications and transaction alerts continue working the same way they did before any of these updates were introduced. The monitoring threshold simply adds one more protective layer within the bank's existing internal security framework. Working together, these various tools help build a stronger and more comprehensive defense against unauthorized account activity. There is another situation that is worth thinking through carefully. Some bank accounts are shared between married couples or include authorized access for a trusted caregiver or a family member. Joint accounts naturally tend to show a wider variety of transactions since more than one person is actively using them. However, bank systems often become familiar with established patterns over time, as long as the activity itself stays reasonably consistent. Patterns like these are generally treated as normal and expected behavior. That said, if a brand new user suddenly begins sending unfamiliar transfers to new recipients in rapid sequence, that kind of activity could appear unusual to monitoring systems. If you have recently added a new person to your account or made significant changes to how you typically conduct your banking, having a conversation with a bank representative may help ensure that the account history clearly reflects those intentional changes. Open family communication can also play a genuinely meaningful role in this process. When relatives and trusted individuals have a clear understanding of your regular expenses and the transactions you have authorized, it creates a more transparent picture of what normal activity looks like for your account. That transparency can make it considerably easier to distinguish legitimate transactions from unauthorized ones whenever questions arise. It also helps protect family members who assist with financial management from any misunderstandings that might occur during a routine review process. Consider what this type of monitoring truly means when you think about it in concrete and practical terms. Many retirees plan their monthly budgets with great care, accounting for rent or mortgage payments, utility costs, prescription expenses, groceries, and a range of other necessary monthly obligations. Within that context, even a few $100s taken without authorization could create real and immediate hardship. Discovering that kind of unexpected loss can be both financially damaging and deeply stressful on a personal level. Stopping suspicious activity before funds are actually removed from an account is almost always far more effective than attempting to recover money after it has already been taken and transferred elsewhere. That core principle is one of the primary reasons financial regulators continue to encourage preventive monitoring, rather than depending entirely on after-the-fact investigation once losses have already occurred. Some viewers also wonder whether these monitoring rules have any connection to possible stimulus payments or special government assistance programs. In general terms, if the federal government authorizes any form of economic assistance payments, those funds would be distributed through the same Treasury systems already used to deliver regular benefits. Monitoring procedures do not prevent those deposits from reaching individual accounts. Instead, they are designed to help protect funds after they have already arrived safely in someone's bank account. It is also worth noting that additional deposits of any kind can attract the attention of scammers, so having robust security systems already in place may actually provide an additional level of protection when those deposits occur. Occasionally, older adults express concern that banking regulations are somehow intended to restrict or limit their financial independence. That concern is entirely understandable given that many policy discussions have historically not given enough focused attention to the specific needs and circumstances of seniors. However, the monitoring tools described within consumer protection programs are typically aimed at identifying fraud rather than placing limits on legitimate account activity. The fundamental purpose is to help detect suspicious transactions while allowing customers to continue managing and accessing their own money in the normal ways they always have. As you take in this information, think about how it might apply directly to your own personal situation. Whether you receive one government benefit or multiple, whether you prefer banking in person or managing everything online, and whether your account belongs to you individually or is shared with someone else, the central idea remains consistent throughout. Your benefits continue to arrive according to the rules and schedules that have always governed them, and financial institutions continue developing and improving the tools they use to protect account holders from unauthorized activity and fraud. One practical step worth considering after watching this video is reviewing the alert settings your bank currently has available for your account. Many financial institutions allow their customers to activate notifications for deposits, withdrawals, or transfers that exceed a certain dollar amount. Receiving those alerts means you can stay aware of account activity as it happens and identify any unfamiliar transactions at the earliest possible opportunity. When your own personal alerts work in combination with the monitoring systems your bank already has operating internally, the overall level of protection surrounding your account becomes meaningfully stronger. Another genuinely useful step is making absolutely certain your bank has your most current and accurate contact information on file. Your phone number, email address, and mailing address should all be kept up to date so that if your bank ever needs to reach you to confirm account activity, they are able to do so without any difficulty or delay. Outdated contact information can sometimes slow down the verification process significantly. So keeping those details current is a simple but genuinely important precaution to maintain. It may also be helpful to keep a basic written record of your regular monthly expenses, including the bills you pay each month, the approximate amounts involved, and the dates when those payments typically go through. This does not need to be elaborate or complicated in any way. Even a simple handwritten list can make it noticeably easier to recognize anything unusual when you sit down to review your account statements. It can also help you respond quickly and confidently if a bank representative ever contacts you to confirm a specific transaction. Small organizational habits like this, maintained consistently over time, can contribute in meaningful ways to your long-term financial security and peace of mind. Ultimately, the vast majority of retirees place enormous value on stability and a genuine sense of security when it comes to managing their finances. After a lifetime of working and contributing to programs such as Social Security, people come to rely on those benefits as a steady and dependable foundation of their monthly income. Financial institutions and regulators continue working to strengthen the systems intended to help safeguard that income from fraud and from unauthorized access. Monitoring guidelines, including thresholds such as the $250 example we have discussed throughout this video, represent part of that ongoing effort to improve protection within a digital banking environment that continues to grow and evolve. Financial regulations can sometimes feel complicated or difficult to follow when they are described in formal official language. However, the underlying goal behind many security measures is actually quite simple and straightforward. The aim is to prevent criminals from gaining access to money that does not belong to them. The technology involved may be sophisticated and complex, but the objective at its heart remains clear: building and supporting safer financial systems for everyday consumers throughout the country. If this video helped bring some clarity to how banking security measures work and why they exist, please consider passing along this information to someone in your life who might benefit from understanding it as well. Here on Seniors Pathway, the consistent goal is to offer clear and accessible explanations about financial topics that directly affect retirees and benefit recipients. Staying well-informed can help people feel more confident and capable when managing their finances and responding to changes that occur within the banking system over time. As financial technology continues to advance and develop, additional security measures will likely emerge in the years ahead. New tools and updated policies will probably continue appearing as digital transactions become an even more central part of everyday financial life. Even as those systems grow and change, the core elements of retirement income programs continue operating according to the established laws and policies that have always governed them. Social Security benefits continue flowing through the existing system. Pension programs continue operating according to their individual plans. Individuals retain the full right to access and manage their own bank accounts as they always have. What continues to evolve is the technology used to monitor accounts and detect suspicious activity before harm occurs. More capable and sophisticated security systems can help strengthen the layer of protection that surrounds those funds and keeps them safe. Staying aware of financial updates as they emerge, maintaining consistent and predictable banking habits, and keeping an open line of communication with your financial institution are all straightforward and practical ways to support that ongoing protection. The most important takeaway regarding the $250 monitoring concept is that it represents a security-oriented approach rather than any kind of restriction on your freedom. Its purpose is to help identify unusual transactions and reduce the overall risk of fraud affecting the accounts of everyday consumers. Understanding clearly how these systems work and why they exist can help bring genuine reassurance and confidence to the process of managing your retirement finances each and every month.